In our previous lecture, we discussed about what is accounting. Today we are going to discuss about classification of accounts and its rules. Before going to journal entries, this is first step, right? Before going to first step of accounts, we have to know about classification of accounts and its rules. Why? Because we have to record day-to-day transactions as per accounting rules. We have different types of accounts. These accounts have different types of rules, and these accounting rules will help keeping track of all financial transactions within the business, such as any money coming in, any money going out. That's why first we need to know about classification of accounts and its rules. Let's go to our lecture. Accounts are mainly classified into two types. One is personal account, another one is impersonal account. And again, impersonal account classified into two types: real account, nominal account. Let's go to detailed information about personal account. Personal account is related to persons. It can be natural or artificial persons. Natural persons like individuals, customers' names, vendors, capital accounts of owners, drawings, etc. For example, Raju's account, Mr. X, Miss Y, and representatives also like capital, drawings, sundry debtors, sundry creditors, etc. And next, artificial persons. Artificial persons like companies' names, firms, associations, bank names. For example, SBI Bank, XYZ Company, the National Basketball Association, ABC and .co. And here, personal account rule is debit the receiver, credit the giver. We are talking about personal account, right? Here, the person who is receiving something, he will be debited. The person who is giving something, he will be credited. Let's go to practical explanation for the personal account. For example, amount received from Ravi of 10,000 rupees. Here two things are happening. One is Ravi is giving the amount, another one is receiving cash from Ravi. In first situation, here person name is included, so it will be coming under personal account. Ravi is giving cash, so he will be credited. In second situation, here cash is included, but cash is not a person, it is an asset. We will learn in the next topic about the cash. Journal entry for this transaction is cash account to Ravi account. Here we credited Ravi. Why? Because Ravi is coming under personal account. As per personal account, who is giving something, he will be credited. That's why we are credited Ravi. And next, we debited cash. It is not related to personal account. We will learn in the next topic about the cash. Here I mentioned one note, that is, in accounting every transaction has two aspects or two effects. One is debit, another one is credit, and both must be equal. Here also in this transaction we have also one is debit aspects, another one is credit aspects, and these amounts are must be equal. Okay, let's go to next step. Real account. Real account is related to business assets. It can be tangible or intangible. Let's go to tangible assets. Tangible assets are typically physical assets or property owned by the company. Tangible assets are the type of assets that can company use to produce its products and services. Next, for example, machinery, buildings, land, premises, vehicles, etc. Next, intangible assets. Intangible assets do not physically exist, yet they have a monetary value since they represent potential revenue. For example, patent rights, trademarks, goodwills, copyrights. Okay, sometimes we have assets are tangible and intangible in nature. These assets are called current assets. For example, cash equivalent, account receivables, account inventory, marketable securities, prepaid liabilities, and other liquid assets. Let's go to practical explanation for real account. Real account rule is debit the what comes in, credit what goes out. Here we are discussing about real account. This real account is related to assets. The asset which is coming into company, that will be debit, which the asset which is goes out from the company, it is credited. Okay, For example, machinery purchased 50,000 rupees. Here two things are happening. One is cash paid to someone, another one is machinery coming into our company. Here in first situation, here cash is included, so it will be coming under real account. Cash is an current assets and it is paid to someone, which means it goes out from the company, so it is credited. In second situation, here machinery is included, so it will be coming under real account. Machinery is a fixed assets and it is purchased by the company, which means it comes into the company, so it is debit. Let's go to journal entry for this transaction. Journal entry is machinery account data to cash account. Here we credited cash. Why? Because cash is coming under real account. As per real account, which is goes out from the company, it will be credited. The cash is goes out from the company because we are purchasing machinery. Next, we debited machinery because it is also coming under real account. As per real account rule, which is comes into the company, it will be debit. Next, nominal account. Nominal account is related to expenses, losses, incomes and gains. Let's go to expenses. In accounting terms, expense means the operational cost that is paid to earn business revenue. It means the outflow of cash in returns for goods and services. Expenses are two types, direct and indirect expenses. Let's go to direct expenses first. Direct expenses are those expenses that are directly connected with the manufacture and purchase of goods and bringing them to the point of sales. For example, carriage inwards, freight inwards, factory lighting, coal, water and fuel, royalty on products. Next one is indirect expenses. Indirect expenses are those expenses not directly accountable to process that contribute to the creation of goods and services. For example, business and administration expenses, sales and marketing expenses, economic and other expenses such as rent, salaries, insurance, taxes and legal charges. And next, loss. The excess of expenses over related revenue. Loss means the excess of expenses over related revenue. In other words, losing worth of money without getting any beneficial returns, that's called loss. For example, cash or goods lost by theft or a fire accident, and loss on sale of assets, etc. Incomes, the amount earned by the business from the business operations and non-operational activities. Incomes are two types. One is direct and indirect incomes. First, go to direct incomes. Direct incomes, the income which is earned by the business from the operational activities. In simple words, amount earned from the sale of goods and services. For example, profits from the sale of products. Next, indirect expenses. Indirect incomes. The incomes which is earned by the business from the non-operational activities. For example, interest received on investments, discounts, commission received and dividend received. Final one is gain. A good example of gain is when you purchase a piece of land, house or security and after some years you can dispose it at a price above the purchasing price. That is your gain. Let's go to practical explanation. Nominal account rule is all expenses and losses are debit, all incomes and gains are credit. For example, rent paid 20,000. Here two things are happening. One is company paying rent, another one is cash going out from the company. In first situation, here rent is included, so it will be coming under nominal account. Rent is an expense, it is debited as per nominal account. In second situation, here cash is included, so it will be coming under real account. Cash is a current asset and it is paid to someone, which means it goes out from the company, so it is credit. Let's go to journal entry for this transaction. Journal entry is rent account data to cash account. Here we debited rent. Why? Because rent is expense. As per nominal account, all expenses are debit side. And next, we credited cash. Cash is real account. not related to nominal account. Cash is real account. As per real account, which asset is goes out from the company, it will be credited. That's why we credited cash. Finally, once again I am repeating, personal account is related to persons. It can be natural or artificial, and personal account rule is debit the receiver, credit the giver. Next, real account. Real account is related to assets. It can be tangible or intangible, and real account rule is debit the what comes in, credit the what goes out. Final one, nominal account. Nominal account is related to expenses, losses, incomes and gains. Nominal account rule is all expenses and losses are debit, all incomes and gains are credit. Okay, we will discuss a practical explanation more on journal entries in next video. Thank you.